Well, everyone, I don't know what I'm more excited about in today's video. Either my new camera setup that I finally got installed here for the Data Dash channel, and I think many of you would agree was probably well overdue as an improvement, or a story that has gotten thousands of cryptocurrency traders and investors concerned about a market sell-off that could come here in the next couple of days or weeks due to systemic risk tied to the largest cryptocurrency stablecoin known as Tether. Now, before we dive into anything, guys, I highly recommend, if you haven't already, to read the article. I have it linked down below. If you want to get the full story, you really don't need to, because in today's video, we're going to be providing a broad summary of what the article is projecting, in this case, the narrative that it's trying to drive home. And along with that as well, I'm going to be spending some time here to talk about whether or not this is something we should be concerned about or something we shouldn't be concerned about. You know, we've been down this road before with news that's come out with Tether that causes all this fear in the market and then nothing really happens. And along with that as well, I want to spend some time to talk about some potential flaws in the article, as well as some potential risks that the article didn't really cover or possibly missed out on. And last but not least as well, above all, helping you guys to stay protected and secure as much as possible with your portfolios in the event that something might go wrong, okay? So without further ado, guys, let's go ahead and dive straight into it, provide a candid, open look at this article here. And this is the article here. It's a Medium article from an anonymous writer within the cryptocurrency space titled The Bit Short. Now, if you guys don't get the reference, it's referencing towards The Big Short, which is a pretty well-known financial film that covers, pretty eloquently how the 2008 financial crisis happened in the housing market, the build-up in the early 2000s, and really what led to the systemic risk and then led to the collapse. Without diving into that, though, as we can see here, by making that reference, the author here in this case, as you read throughout the article, is talking about how one of the largest stablecoins within the cryptocurrency space, Tether, possibly played the leading role in driving Bitcoin's price up over the last coming months, as there's been a record amount of new Tether being issued. And then along with that as well, a possible major sell-off with the removal of Tether from the market. Now, I want to make it clear here before we dive into anything what a stablecoin is or what Tether is, because I know there are many of you out there who are new to the cryptocurrency space, and maybe some of you who have heard about it but don't really know why stablecoins exist and what Tether really is. So to put it simple, a stablecoin in this case is a cryptocurrency token issued on some kind of blockchain like Ethereum that, generally speaking, is aiming to peg itself to something else in the sense of its value. So in the case of a dollar stablecoin, it's a token that its core objective is to basically hold a dollar value in this case. So that when I hold, for example, a Tether, I should have roughly about $1 worth of value. If I have 10,000 Tethers, I should have hopefully around $10,000 of value in my cryptocurrency wallet. Plain and simple. Now, there are a range of different stable coins that we can kind of learn from and see differences in. There's USDC, which is created by Circle and Coinbase, two of the leading companies within the cryptocurrency industry. They have auditing and basically have a reputable track record of $1 in a bank vault for every one USDC that they create. There's also crypto collateralized stablecoins like DAI, or it's spelled DAI, just to be clear if you guys want to look into it, that's basically backed by cryptocurrencies like Ethereum or other types of digital assets that serve as collateral in order to issue those stablecoins. And it's verifiable on chain that there's an actual amount of collateral backing those DAI being created. However, Tether falls into this gray area. It's not only the leading stablecoin in the market in the sense of the total supply in the market, but outside of this as well, in this case, there's no serious audit in this case. There's no blockchain record to really track if there's actual dollars in the system. But along with this as well, we don't really have a clear audit overall about whether or not there's an actual one-to-one backing. By now, it's become apparently clear, even Tether doesn't really deny this, or Tether Limited, the parent company. There is no one-to-one backing in the sense of real-world dollars. This is something that was claimed a long time ago, and nowadays it's more of a one-to-one backing of other types of different assets. That's the claim that's made from Tether Limited as a company who issues Tether. Well, this article goes about trying to dispel that narrative and really talk about how much systemic risk lies behind Tether and how much potential fake Tethers have been printed, or fake stable coins have been printed, in order to prop up Bitcoin's value, and with a potential removal of Tether due to regulatory concerns and regulators clamping down on Tether Limited as a company, that this might cause a massive market crash for Bitcoin and other cryptocurrencies alike. So again, I'm not going to be able to summarize the whole article here. It's a 22-minute read, but let's just go ahead and scroll down here and talk a little bit about what the article really hits on. I mean, there's a lot of different data points that they mention, but they mainly reference how Tether is overwhelmingly the entry point of new capital into cryptocurrency markets when you talk about money flows. So for example, new money flows or volume with Bitcoin within a 24-hour period, right? We can see Tether outpacing heavily traditional US dollars through traditional banking networks like ACH transfers or wire transfers, as well as other currencies like the Japanese yen, euro, and the British pound. So we can see this quite clearly here on the screen, and also how it flows and other types of cryptocurrency assets. Now, overall here, this definitely does look a bit concerning to some people, especially as you go throughout the article and they dive into kind of like some of the broader concerns here with Tether. Now, I want to kind of scroll up to this portion here because I think this kind of summarizes what I think the article does get right. What the article gets right here is something that I think most of us have been echoing in the crypto space for a long time. The biggest red flags that Tether Limited has as a company is that unlike USDC and most reputable stablecoins on the market, especially being the largest, Tether has still yet to provide a clear, reputable audit of how much reserves there are backing up each and every Tether. And this is a massive problem for transparency's sake. They've constantly dodged the question. They constantly haven't provided this. This is one of the biggest points that was brought up before by Bitfinex, which was one of the biggest critics of Tether back in 2017. And it's a valid concern. I think completely, I agree with the article here. I agree with anyone in the space that's brought this up as a valid concern. But outside of this as well, there's also been some issues with the New York Attorney General. They've been kind of playing this cat and mouse game where they haven't really, been able to just simply provide simple documentation. They've been appealing the claims from the New York Attorney General. And again, as much as I have no doubt, maybe Tether, for example, might just, regulators can sometimes be a burden sometimes, but at the same time, you have to work with compliant regulators in this case overall. And especially with something as simple as a stablecoin, it should be pretty simple to explain what people are using your stablecoins for, how they're being issued, what kind of reserves you have that, in this case, back up the creation of these tethers, etc. It's not some complex financial company overall. So these are the things that are very valid concerns. If you read through the article, I'd say they're probably the biggest points. But outside of this as well, there's a lot of misconceptions here overall. A lot of things that just simply are, just basically scattered dots being plotted together to build a narrative overall about Tether. So as you read through the article, there's a lot of things, for example, the flow of funds. And again, as much as this looks scary here overall in regards to the cryptocurrencies, where the value is coming for these cryptocurrencies, where the buy side pressure is coming in, this really isn't much of a concern because most volume is in non-traditional cryptocurrency exchanges like Coinbase or Bitstamp or Kraken that get most of their liquidity from fiat on-ramps. They're basically coming in from this purple section. Most of it is the volume in the cryptocurrency space that's being traded with Bitcoin in a 24-hour period is going to be on spot exchanges that basically are only cryptocurrency-based exchanges, so they only allow cryptocurrencies to come in, not traditional bank transfers, and vice versa. You can only move crypto out. You can't move money back to your bank. That's exchanges generally like Binance, OKX, other derivative-styled platforms, etc. that make up a good chunk of this volume here. And along with that as well, they point towards some things, for example, like the stablecoin issuances being big even numbers for Tether versus something like Circle's USDC having these really unique numbers. And this is actually due to a different issuance process, which we'll dive into. There's an individual on Twitter that actually really kind of like challenged my narrative here. His name's David Foucher in this case. I hope I'm pronouncing his name right. But I think he actually not only brought up some valid points here about the good points that the article makes, but outside of that as well, some of the kind of FUD and mistaken points that are made within this article from this anonymous writer who we don't even know who they are. So first off, again, he hits on the point here that, like I've hit on in this case, I think many of us generally agree that overall they should have had an audit. They should be much more kind of eager to kind of provide some kind of audit and stuff overall. But as we go through the article, he hits on a few different things here. And one of the things that I think David does a really good job of overall is addressing the largest growing concern against Tether, and that's its rapidly expanding supply. We can see here that back in December of 2019, really coming to the close of the year and starting off in 2020, we had about $4 billion of Tether in circulation. And a year later here, we've more than 6x'd the supply to $24 billion worth of Tether on the market. It's very valid to be concerned about that growth and ask, why is it that this year we've been able to see such a magnitude in growth for Tether as a cryptocurrency? Well, there's a few key reasons here overall. And David hits on one point here that I think is definitely an important one. It has to do with a big dynamic shift from a lot of traders moving from a well-known derivatives platform known as BitMEX to Binance. And because of this, this has changed the way that derivatives contracts are basically entering into these platforms, or basically how the margin is managed. It is usually done in Bitcoin, now it's done in Tether. But mainly above all here, it's talking here about, above all, the growth and acceleration and demand for stablecoins. When markets move up, there's more need for stablecoins, as stablecoins serve as an on-ramp into the cryptocurrency space for a lot of people, especially a lot of hedge funds and family offices, people who are working with millions of dollars and they need to get it into the crypto market quickly. This can be a great way for them to be able to move money into the crypto space very quickly without having to deal with a lot of the hurdles of the traditional banking system, especially if you're in kind of the offshore world of finance, right? And again, in that case overall. So as David kind of mentions here, as for the recent acceleration, we entered a bloody bull market. That's a good way of putting it overall. So again, we can see this as well back in 2017, just to kind of showcase as an example. We saw the vast majority of acceleration going into November all the way into January, where we peaked out in the altcoin market. It's no surprise that that happened that time around, and that it's happening this time around, as we've had a rapid eagerness from people all across the world to get exposure to Bitcoin and other cryptocurrencies at a record pace. And again, with this as well, we can always look at things in a logarithmic perspective. We can get down here, for example, and you can see that the growth here hasn't really even hit those growth rates that we had back in the past and the overall supply. So again, this is actually quite normal here overall, as cryptocurrency markets are turning from a couple tens of billions of dollars or hundreds of billions of dollars in market cap to a multi-trillion-dollar market, hopefully over the next coming years. It's just expected to happen overall. Now, outside of that as well, David hits here on a couple other points that I recommend you guys read through, and I'll leave the tweet storm down below. You guys can read through it, feel it out for yourself and stuff. You can provide feedback if you like to on Twitter. But overall, again, the major thing I want to talk about is the real risk here when it comes to Tether. We can dive into all the niches in the article here, but I think one of the biggest things that the article doesn't get right is this whole idea that just Tether is propping up the market here and that it's going to implode tomorrow if it's taken out of the equation. That's not exactly true. The real risk here is something that we saw back in March. We likely saw back in March of 2020 that led to the crazy liquidation event in cryptocurrency markets that led to Bitcoin dropping and having one of its worst sell side days in over 7 years, and Ethereum having its worst sell-off day in history, okay? Now, let's go ahead and talk about what's really going on behind the scenes here. What's really going on with Tether? So if you go to Tether's website here, this is a very important thing to read here. When we're talking about this topic overall of Tether being backed by one-to-one pairing of dollars, we already know that this is not true. Like, we know that Tether's already claimed this, and in fact, if you go to their website right here, it says every Tether is always 100% backed by our reserves. Already right there, not stating a one-to-one peg, which include traditional currencies and cash equivalents, and from time to time may include other assets and receivables from loans made by Tether to third parties. That's a very fancy way of saying, give us your cryptocurrency or other equivalent assets, and we'll issue Tether for you. Mainly cryptocurrencies though. And this is something that goes on through the cryptocurrency space quite frequently. If you're, for example, interacting with the Compound protocol, if you're borrowing through there, right, you're providing collateral in this case to borrow stable coins, or you're doing it through Celsius or BlockFi or Nexo or all these lending platforms, it's the exact same thing. Tether in this case is acting as a lender in this case. They're lending stable coins, holding collateral in this case overall, right? Now, overall, we need to understand what this means for cryptocurrency markets. So the first thing here is that we've got people who need stablecoins. They could issue dollars, yen, or euros to Tether Limited to hold as reserves for the issuance of those stablecoins. But in most cases, they're going to be depositing Bitcoin, Ethereum, other types of cryptocurrencies. So they deposit it in the Tether treasury in this case. And then overall, Tether starts to run the money printer, the virtual money printer on the Ethereum blockchain, and print up some Tether tokens to send to the user or business's address. Now, all of this looks fine and dandy. I mean, Bitcoin does have some monetary value, just like dollars, euros, or yen, right? And other world currencies. What's wrong with this? Well, Bitcoin itself is pretty volatile. And the thing about Tether is that one thing that they try their best to hold to, especially as they have a massive incentive to maintain the largest stablecoin in the market. I have no doubt in my mind that Tether in this case is trying to maintain a 100% reserve allocation. Whether they are or not, that's another question. In order to maintain that allocation in that case, set aside for the treasury, the reserve in this case, to back up the Tether issued, you have a growing problem here with Bitcoin and other digital assets as they're volatile. They can go up 30% one day, they can go down 30% in one day, right? If there's massive news in the market. It doesn't usually happen, but it can happen. They can have double-digit moves that cause enough volatility for that treasury reserve. And what happens here is if you have enough of a dramatic sell-off in the market, what you can potentially have is a risk of liquidation. Now, just like on Compound, for example, which is a common DeFi application, if I go out and I, for example, lock up $10,000 of Ether, in this case Ethereum, I can borrow $5,000 of stablecoins. And the reason I do this is maybe I want to go take those stablecoins and go buy more Ethereum or buy other cryptocurrencies to grow my portfolio. Then I pay down the loan at a later date, I get my collateral back. That's how it generally works. And that's probably what a lot of people are doing through Tether. But if my collateral drops down enough to where it gets below the value of what I'm borrowing, or close to it therefore, I can have what's known as a margin call, a liquidation, where I lose my underlying collateral until I either refinance, provide more collateral, or pay back my loan. Right? They have to do this to protect the depositor who's providing you those stable coins. And in this case with Tether, their case is that they have to back it with 100% of the reserve assets. They have to maintain that equalization or try their best to. And if the Bitcoin, for example, right? If we see Bitcoin's value, which we've got indicated here is just like a little illustration, there's my terrible Bitcoin drawing, right? If the price of Bitcoin drops down enough from a normal sell side day, what you might have is a liquidation event. They've got to sell that underlying collateral for those issued Tether. And that's going to further drive down the price here. And this is really the overall problem here. When you have a mass spur of liquidations where too many people have financed on top of their collateral, they've taken out credit, or in this case, Tether, and generated a ton of stable coins in order to maybe buy other cryptocurrency assets, etc. When there's enough of a slowdown in that, and there's enough sell side pressure in the market, this can cause a massive sell side pressure across the cryptocurrency space, an impending kind of vertical drop in cryptocurrency valuations. Now, does this sound familiar to anyone? Does anyone remember a moment in time over 2020 where this happened? For those of you who have been in the crypto market for some time. Reminds me back in March of 2020, where we had one of the worst sell side days, really, over the last, there was about like a 3 or 5 day period, right, where we really started to see a downward move in cryptocurrency valuations. The initial sell-off, initial downturn, massive set of liquidations. I might be wrong on it, guys. Again, it could have been a variety of other factors. It wasn't just Tether in this case. There were a variety of other platforms. There were platforms like Nexo. There were platforms like Compound, MakerDAO. People were getting liquidated left and right. And this showed here that the cryptocurrency space was basically over leveraged, right? Now, this is the kind of comparison that I would say makes sense with the bit short here in this case overall. That, mainly speaking, things are over collateralized when it comes to people utilizing crypto in order to generate more stablecoins and buy more crypto, right? That's definitely a risk. There's also a risk with something that they mentioned in this article, which is that if you are using Tether on these other exchanges that are kind of in the, not per se offshore world of finance, but are definitely not the Coinbases and the Geminis and the Bitstamps of the world, then yeah, you're probably going to suscept yourself to more risk here in this case. You're basically putting yourself up for more risk possibly, especially on derivatives platforms like BitMEX. Again, I would just stay 10 miles away from those, definitely. But overall, that's the general gist here, guys. So let's just go ahead and summarize my general thoughts on this. If you stuck around this long enough, then you guys deserve it. Broadly speaking, I think that the article does a good job of bringing up a great point. We need more transparency here for Tether. At the end of the day, though, using Tether for quick style transactions, I don't think really poses much risk. I can definitely tell you all that I don't hold any of my wealth in this case, or any substantial amount of my wealth in Tether. I would much rather prefer using USDC or, TUSD, some other kind of stable coin that's actually well regulated and audited, or in digital assets that I know are trustless and not claiming to have anything backing them. And overall, right, even though we understand this potential risk here with Tether, that the real risk comes overall in a potential liquidation event for the cryptocurrency market and over leveraging of generating stable coins and getting too confident overall in locking up crypto collateral to generate these new stable coins, right? Again, there's a lot of ways that this Tether supply can increase overall. One of those that is posing some risk is that some of this growth here, not all of it, but a good chunk of it, is people putting up their digital assets and taking out loans, or basically taking out new Tether in order to go out and buy more crypto. And the more and more that happens, there can be just as equal ramifications coming downward. That's the general risk that we need to understand here, guys. Overall, when people take too much credit, in this case, too much leverage and too much exposure to the market. Because just like how it can help it go up, it can also help it go down. All right, everyone, that's it for today's video. I know I rambled on enough today, guys. If you like this video, consider dropping a like, consider subscribing. It always means a lot to me, guys. But I hope that this video provided some good kind of explanation about what's going on in the sense of like if I'm fearful of it or not. Look, yeah, if Tether it gets removed tomorrow, yeah, definitely. It's going to probably have a short-term negative price impact on Bitcoin. But it's not going to kill Bitcoin. And we've had this story going on for years and years in cryptocurrency markets. We'll have to see if it plays out. And I'm betting overall that this is going to be something that slowly but steadily will either kind of work itself out, or we're going to start to have more of a clear answer over the next coming weeks. Okay? So best thing you can do, put your wealth in stablecoins that are well audited, or put it in your favorite digital assets and don't cough it up for stablecoins that may be printed out of thin air. And as always, keep a long-term perspective here on the cryptocurrency market, guys. That's it for today's video, and I'll see you all in the next one. Take care, everyone.